holding the stock. Not an entry point, but keep playing your stock to 40-50.
All right, first trade's coming up right now. 26,130 is where the Nifty is starting. 60,000 and 60,001 blinking red and green, basically nothing at all. So just about trying to find its footing. About 0.25% lower on the Nifty. The Nifty Bank is down about 0.15, 0.2. The mid-cap index is absolutely flat, 34 points lower. And I think the small-cap index, which is coming up on your screen also, which is down about 0.25% or so. So it's uniformly down about a quarter. Mid-cap, though, the mid-cap index has just about come back into the green. 61,160 is where the mid-cap index is at. 750 stocks are higher, 740 stocks lower. So, I think it's absolutely evenly balanced. But it's all about single stocks. Senco at the bottom of the screen and a bunch more we'll get to. Titan, of course, is the other one. That's a Nifty heat map. Titan is on the one end of the spectrum after that very strong third quarter update. There is Infi, HCL Tech. So I think I can see some positive color on IT services names, at least two large caps there. Cipla, HDFC Bank and Tata Motors passenger vehicle is lower. But more down than up, some 33, 32 names which are lower and the rest which are higher. 60 points down, about 0.25% is what that translates into. But it is single stocks in action. Rima.
Particularly the gold jewelry companies. Look at Senco, 10% up on that. Kalyan Jewellers up 1.5%. And of course, then the giant Titan, which on a very large base has seen the top line compound or grow at 41%. Titan sees buying, stock is up 3.5%. Interglobe Aviation also up in the green. IT, the Nifty IT index has a positive start with names like HCL Tech, Infosys, Wipro opening up in the green. ITC is another mover, and M&M, which launched a new variant of their XUV 700 at a price point of about 13-14 lakh, has opened up in the green. On the way down, some softness visible in pharma names. Pharma was the biggest sectoral winner yesterday, but today profit booking visible in Cipla. Is there some news in Cipla? Stock is down 2%, so it's not just a mild cut, but Cipla is down. You've got a mild red coming through on some other names like Sun Pharma, Dr. Reddy's. Tata Motors passenger vehicles under pressure for the second day in a row on the back of the disappointing auto sales numbers. And HDFC Bank, that continues to be the problem. Third day in a row, HDFC Bank opens with a cut of 1%. Now in 3 days, the stock is down nearly 5%. Outside of that, Shriram Finance, Maruti, Bajaj Finserv. The two stocks we should pull up are Trend, because it was down 8.5% yesterday. And the other one is Reliance Industries, the big contributor to the fall. Trend opens flat. Reliance sees a mild green, up 0.5%. So some signs of life now in Reliance.
Well, that's right. Good to see the big boy fight back in today's trading session. Yesterday, maybe in fact, it ended towards the low point of the day. So important to track that one. Jefferies, for one, they continue to maintain their positive outlook on Reliance Industries. Moving to other stocks in focus, though. Bliss GVS Pharma. Nimesh had mentioned yesterday the street is sniffing maybe a possible M&A opportunity out there. And yesterday, the stock perked up. It was already up 10% when Nimesh spoke about it. It had perked up, I think, to around 18-19%. And today, it's building onto some gains. So stock up close to around 4% in the initial few minutes. Cupid has been all over the place. Volume's massive today, but that stock's up close to around 4.5%. A few other notable names. IRB Infra, positive news flow coming in there. Stock up close to around 2%. Nalco cooled off yesterday towards the end of trade, but today, in fact, it's popped up close to around 2%. So telling you that aluminium rally still continues out there in line with what we're seeing in terms of global prices, maybe getting a little bit tricky in comparison to a month or so ago, but that stock continues to build onto gains. Welspun Corp, there's an order win out there. The quantum, though, is something that we are still checking. But the order inflow has been very, very strong, and it's giving them good visibility for the next few years. So that stock is well up and about in today's trading session. What's down? Misho. Keep an eye on that stock. Massive volumes. Stock down close to around 5%, so it's falling on rather large volumes. Ola Electric, in the last month or so, the stock has done a quick fire. 32 to 42 rupees on the stock. But that one, in fact, in today's trading session, it's come in for a tinge of profit taking down as we speak. So that's about some of the top movers in today's trading session. Mid-cap index outperforming, headline index down only around 50 points. Prashant?
Well, I think, some stabilization perhaps as we go along. Bliss has seen a 1.2% equity which has changed hands. And as Nigel pointed out, it was part of our D-Street chatter yesterday. Okay, there's more up than down for now. 1,400 stocks are higher and about 1,000 stocks are lower. Bunch of these silver ETFs, silver Bs and there is HDFC Silver and Tata SBI. I mean, these are all the entire silver instruments are up between 3 and 4% once again. So it's a massive move which continues across these products into 2026 after a phenomenal 2025. No stopping for now. Tata Technologies is up about 3.25% or so. I think there's an upgrade on auto ER&D companies. There's, I think, Tata Tech is mentioned, I think maybe signed, etc. But 3%, I think on the back of that, one of the, I think JP Morgan, I believe, will try and check and put that out. But I think it's on the back of some upgrades which have been put out. On the downside, we've already highlighted Meesho, and I think Dixon we've highlighted. Indian Hotels, that downgrade from Morgan Stanley.
They've downgraded it to an equal weight from an overweight.
Yeah.
The new target price, the lower target price stands 780, so still higher than current market price. And the key argument is valuations. Adequately captures all the risk reward.
Just one more point. Meesho, since we just spoke about it, the lock-in ended. That explains why that stock is under intense pressure in today's trading session. And also keep an eye out on InfoEdge. The job index data should be flashing for you on the screen. That is just out. So that's the stock that we're looking at. For the time being, it's perked up close to around 2.5%. It's seen a bit of a leg up, I think, in a minute or so. So just keep an eye out on that one. We'll get those details up for you on the screen.
Absolutely, and important one, which we will continue to track. So more on individual names, but the Nifty is now down 20 points, which means we've seen about a 60-odd point recovery, 50-point recovery from the day's low, the starting low in that sense. Manishi Ray Chaudhary is with us. He's Chief Executive Officer, Emmer Capital Partners. Manishi, good to have you here. Thanks very much. I have a slightly macro-ish question, because micros we can get to in just a bit. That tobacco tax increase by the government that we saw, revenue collection for the government is under pressure. I mean, I think we can all agree to that because of the numbers that we get. Do you think we will see more attempts at shoring up revenue? Some believe perhaps the focus will be sin goods, liquor, etc. I mean, it's not as if some of the state finances are also extremely stretched. What's your sense, Manishi? Is that a signal? I mean, you can also take that argument to oil, an excise increase. We don't know if it will happen, but it sure is chatter. Go on.
Right. Thank you very much, Prashant. Good morning to you and a Happy New Year to you.
Happy 2026.
Absolutely. Thank you. Right. So, I think government revenue, and consequently the fiscal deficit, the potential for the fiscal deficit to increase is a real challenge. It's a real concern. And that is something we have to look forward to in this budget as well. And what you pointed to, that is increase in taxes in certain consumption segments, that is a very real possibility. I would be happier, and this is something I would be looking at keenly as far as this budget is concerned. If there are, kind of non-tariff or non-tax revenue sources that can be tapped by the government, maybe monetization of more government assets, maybe a few more privatizations. If the resources are raised through those non-tariff, non-tax sources, obviously that's the best outcome. But otherwise, it's a very kind of I would look at it very keenly, that how the government plans to kind of close the potential fiscal gap going forward.
Manishi, since you have this entire emerging market bias, based on what we've seen geopolitically, are there any implications for your, for any of the emerging markets? For instance, you're overweight Hong Kong, China. You sort of increased your weightage on India. Any thoughts on how this impacts the way you thought about emerging markets, the development?
Right. So, what we've seen over the last few days underscores one clear driver of 2025 that's going to continue in 2026, and that's geopolitical tensions. It's a new normal that we have to live with, that geopolitical tensions are here, and consequently, we're going to see increasing defense expenditure. There are plays on that in India. There are possibly larger plays on that in Korea, and those are something that we are banking on. We're also going to see the impact of that in commodity prices. We already saw the so-called safe haven trade or the debasement trade in terms of gold and cryptocurrency in 2025. We are going to see more of that in 2026. And even in some of the base metals, that is likely to seep through. We are possibly entering a kind of a commodity super cycle. I mean, I kind of hate to use that word super cycle, but a strong commodity cycle going forward. While we have seen that in precious metals, we are going to see that, and we have partly already seen that in 2025 in the base metals and possibly at a later date in the ferrous metals also. So those are some of the important themes, debasement trade, geopolitical tensions and defense expenditure, and commodity prices going up that we have to focus on in 2026.
Okay, all right. Manish, just hold on to that thought. Info Edge, the December IT sector hiring is up by close to around 8%. Explains why that stock, in fact, has perked up today. And in fact, the insurance sector recorded a 34% overall increase. So just pull up the intraday chart. The stock is unmoved for the last month or so, but in today's trading session, it's perked up. And just one more sector of stocks that we're looking at. We had mentioned just before market opening that yesterday the street was a little bit troubled about the CCI probe with regard to steel companies. But in today's trading session, these stocks actually have bounced back up because it will be very difficult to prove the legalities with regard to that. Tata Steel is holding more or less flattish. SAIL has pulled back some of the losses that we saw yesterday. And JSW Steel as well, the last time I checked. That stock as well, after starting off in the red, it had moved into the green, as is the case with Jindal Steel. So all these stocks, they're pulling back a little bit from the lows. Hi, Manishi. Good to see you. When the next few days, the tech numbers start pouring in. Tech and real estate, the two worst sectoral indices of 2025. Would you bet on them in 2026?
Now, tech is something I'm still keeping away from. Indian tech is a classic AI loser, and I had used this phrase earlier on your channel also, and I'm sticking to that point of view. At some point, as a consequence of these AI investments, the IT services would also have to pitch in to, kind of coordinate and link all this massive investment that's going on. But that time is not now. At least in the near to medium term, over the next 6 months to 1 year, we will possibly see the threat of AI replacing the coders of the Indian IT companies. That concern would possibly be stronger than the potential benefits to the IT companies that could come later. Real estate is something different. I would be selectively positive over there. There are various ways to play that. One could even play the real estate positive sentiment through some of the banks in India. But it did well between 20 to 24. Then 25 was not quite a good year. But I think, some of these laggards of 2025 could, bounce back selectively in this year.
You spoke about commodities being in a super cycle, and already last year we've seen some big gains. At what point will the inflation start hurting automobile companies in India, or even the renewables play? For instance, you need a silver, copper, etc. in solar panels, inverters, etc. I mean, what are your thoughts on the adverse impact of this commodity super cycle? And to play the commodity super cycle, do you have a view on Indian metals?
Right. So we are, I'll answer your second question first, because that's a lot easier. We are playing the commodities super cycle theme through copper and aluminum. Not so much through the Indian companies in our model portfolio. We have more exposure, larger exposure in China. The likes of Zijin Mining or China Hongqiao, which are into copper, aluminum, also some of the gold plays in that market. These are not only companies with stronger growth forecasts in terms of earnings growth, but also a lot cheaper, than the Indian counterparts. Now, having said that, I think in terms of when we have a situation of a super cycle, pretty much every boat tends to be lifted up. And we would see some part of that in Indian companies also. Your first question is a bit more complicated, and it's not easy to take that call right now. certainly there would be an impact on the margins of the commodity users. So we have to look for those companies which are in a position to pass on their cost increases to the consumers. So we would, in all these consumer discretionary, automobiles, these sectors, we would have to look for the market leaders who have the necessary pricing power to pass on their cost increases to the consumers.
Okay, all right. Manishji, what about this FI holding year in India? 2025, all through the year, we kept saying that their holding is declining. It's declining even more. And towards the end of the year, ended at the lowest we've seen in multiple years, more than a decade. Yeah. What's your view with regard to the kind of interest that we're seeing in the Indian markets? Valuations are not cheap, but it's never been the case. We underperformed the MSCI emerging market, by the highest margin all the way since 1994. And their holding is at, very low levels. Growth should come back. Earnings growth should come back. Do you think we welcome back some FI flows in 2026?
Right. So, you're, again, coming back to your original question, what is the reason behind this, the lack of enthusiasm on the part of the FIIs? Equity markets are driven by three basic factors. Their earnings, their interest rates, and currency. In the emerging market context, currency is also an important variable. Now, in case of India, it's only one of these factors which are possibly right now on a positive note, where you have earnings estimates or where you have interest rates declining and possibly likely to decline even more in a benign inflation scenario. But the other two factors, the currency and earnings, they have not been in India's favor. And we think that they will, and on the other hand, we're seeing earnings estimates reviving in North Asia. Asia, Japan itself, the consensus EPS estimate has moved up about 4 to 5%, driven largely by North Asia, China, Korea, Taiwan, etc. So for FII interest to come back on a sustainable basis, those variables will have to be stabilized. Earnings estimates will have to revive. The currency will have to stabilize. There are several factors that could drive these. We have seen part of that in 2025 with a lot of fiscal stimulus being thrown in India. The currency, well, no one knows when the trade deal, the US-India trade deal would finally be signed. That could be a trigger. So many of these building blocks would have to fall in place before sustainable FII interest comes back.
One final question, it'll lead into the next discussion that we're having. Do you own any of these quick commerce, Eternal, Swiggy, a pre-placement perhaps in Zepto? Because there is this standoff between the company, the platforms and the union. There was this large strike which took place on the busiest day ever on 31st of December. And the union is demanding social security, higher wages. If that comes, maybe not to the extent the union is asking, but even if there is any increase in the costs for these platform companies, it questions the profitabilities, it'll hurt. I mean, is that a big risk for platform, the shareholders of people who own a Zomato and a Swiggy? How are you reading it, the developments?
So, in our model portfolio, we don't own any of these, the Swiggies and Eternals of the world. And, I think the manpower-related concerns that you point out, they could hurt these companies, but I think it would be a short-term impact. The bigger story for these companies is the long runway, the long pathway of market penetration that they have still ahead of themselves. In the process, if we have a degree of valuation correction, I think that would actually provide a buying opportunity for investors who don't own many of these companies.
What's the extent of a correction that would interest you, make you buy a Zomato or a Swiggy? A 10%, 20% lower?
I would say it's possibly closer to 20% than 10%.
Got that.
By the way, markets are still treading water, right? 40 odd points lower, sideways, and just about sort of going around. It's not decisive, let's just put it this way. One other name, right? We're talking about Senco and Kalyan and Titan. The smallest of the lot is Tribhuvan Das Zaveri. That is 10% higher, TBZ. So every few years, TBZ wakes up and makes a big, massive move and then sort of, goes right back to sleep. I'm not sure if that is what is happening here. Yeah, I mean, I think that perhaps would be close to an accurate description of what the stock does. MCX is up 3%. So 23.10 after it underwent that split. Stock set basically pretty much highs on MCX. Precision Wire, lots of names. I mean, Natco is up about 3%. I think we highlighted MV, which is the Jefferies had initiated coverage yesterday, day before yesterday, 6.5% again this morning. GM Breweries results reaction, it's up about 3% or so. So it's not a bad-looking broader market screen. Yesterday, of course, was a bit of an aberration where the headline frontline indices were sulking, but broader markets also sulked, which wasn't the case the day before. Thank you very much, Manish, for joining us. It's always a pleasure having you with us here. And once again, wishing you all the best for 26.
Thank you. Thank you very much.
Okay, well, let's just talk about the hot story, which is the unit economics of quick commerce companies. It's a raging debate. Mangalam is here with the math of it, how it works out. Mangalam, over to you.
Well, we'll keep it very simple. For a 600 rupee average order value that you make on a quick commerce app, which is pretty close to what both, Eternal and Blinkit reported in the second quarter, what is it that the platform gets? What is it that the platform spends? And more importantly, how much do gig workers get? And how does this scenario play out? So if you look at a 600 rupee order, the take rate or the gross margin is the important thing that the platform gets out here. At 15%, it's about 90 rupees. And then there is brand commission, all the advertisement that happens on these apps. So, 3% of that would amount to 18 rupees. And then there are delivery and other charges which are paid for by the customer, that's you and I, which is about 12, though increasingly companies are waiving this off to boost consumption on these apps. So, that's about 120 rupees that they make. Where is it that they spend their money? Dark store operations and dark store rent account for nearly 11%. So 42 and 24 rupees out there. Rider payout on an average is about 50 rupees per order. And then you have shrinkage and other expenses. So all in all, if you look at just the unit economics of this business, at an average order value of 600 rupees, the revenue that the company makes is 120, fulfillment cost is about 132, and contribution loss is about 12, which means that the contribution margin is a negative 2%. As average order values increase, that's the important parameter to track here for contribution margins to improve. Now, from a gig worker standpoint, quick commerce delivery gives them about 40 to 50 rupees per order. Food delivery gives them about 50 to 70 rupees per order. But remember, food deliveries travel longer distances. So the key metric to track here is earnings per hour. And on an average, that normalizes to anywhere between 90 to 130 rupees on a gross basis. And take those expenses out, it's about 70 to 120. What are the revenue drivers? Average order value. The higher they go, the better it is for operating performance out there. Or you can have a higher gross margin or a higher take rate depending on the product mix that you have, the assortment. What are the key drags here? Rider payout. If the rider payout increases, then that, as we'll see, impacts the business a lot more. Dark store inefficiencies are the others. The important thing that I'll be tracking as we move along are free deliveries and discounting as competition heats up. But that's something that we will track only once, we do see that happening on the ground. So let's talk about the rider payout. That is an important fixed cost. If you look at the average order values of 400, 500, 600, at any rider payouts, obviously all of them are contribution loss making. But I did a stress test and looked at it at upwards of 600 and upwards of 700. The model currently makes more sense at 700 to 750 rupees as order value. And as the next plate comes up for you, currently the rider payout is 50 rupees. So, you just about break even at 700, 750, make a little bit positive, contribution margin at 800 and about 2% at 1,000. But if this 50 rupees goes to about 60 rupees, then your average order value for break-even increases from 750 to about 850. And a further 10 rupee increase to about 70 rupees boosts your contribution or puts further your contribution profitability by another 100 rupees. So for you to make profit as a quick commerce player, the sensitivity to rider payout is extremely high. Currently, the model makes sense at 750 rupees or 700 to 750 rupees. If the rider payout increases by 10 rupees per order, the AOV has to go up by 850 rupees. And if it increases further by another 10 rupees, then the AOV for contribution profitability increases by another 100. So maybe you'd be making profit only at 1,000 rupees.
Very well explained. Thank you very much for that. And to take this forward, we have with us Sarvanan CR, COO of Updata Services. We also have Ramani Datti, CFO of Team Lease Services. And just to take our viewers through the timeline of the conundrum and, why this quick commerce gig workers payout, the rider payout is in question. Because the standoff between the union workers and these platform companies escalated rapidly towards the end of 2025 in the holiday season. The gig union workers submitted a formal list of 15 demands to the Labour Minister, including a 40,000 minimum monthly wage and a ban on 10-minute delivery, citing safety concerns. On 31st of December in the evening, there was a nationwide strike which began, and the unions claim over 2 lakh workers participated. Dipinder Goyal labelled the strike and the organisers as miscreants. But on 1st of January, these platform companies reported record volume, saying the strike had limited impact. Politicians also stepped in. Raghav Chadha criticised the 10-minute model as inhuman, but Dipinder Goyal defended the model, citing and explaining the monthly services. But the standoff as of now continues. And as Mangalam was pointing out, the operating model, how much the riders need to be paid, decides the entire profitability of this platform. Thank you very much, both of you, for joining in. Ramani, the first question is, do you think the government needs to intervene or leave it to the market forces? And can the gig model survive in its current form if there is an increase in the monthly wages, or if there is a change in the 10-minute model, or if, as Mangalam was saying, right, the current payout is at 40, 50 rupees. If it goes up to 70, 80, how does it change the dynamics, economics?
Hi, Rima. Good morning. So since we are in the business of staffing and hiring these people for the quick commerce companies, as of now, we are not seeing any challenge with the rider payout, which is 50 rupees standard kind of 50 rupees per delivery. But the bigger issue is in terms of job security or social security benefits. So while a majority of these riders are doing it purely as a gig model, there is a percentage, at least 20% of these riders are doing it like a full-time employment. And this is the percentage where there is a higher demand in terms of social security benefits. Fortunately, in the new labor codes, there is a broad mention about the fact that even the gig workers, because now almost close to 1 crore employees are working, not employees. There are people working in gig format, close to about 1 crore currently. And even the labor codes have mentioned about there should be some sort of social security, but unfortunately, they haven't mentioned on like how exactly these social securities would be distributed, because many of these gig workers are working for multiple platforms. It's not like they are working exclusively only with Zomato or only with Swiggy or any other platform. So then how can you define that this is the particular platform that they are, it's their employer? So there are challenges like that. But one thing which we are seeing on ground right now from these platforms is that they are slowly moving a certain percentage of these gig jobs to a full-time contract model. So almost all the back-end logistics and a work which is typically an 8-hour work for the day, those profiles, they're slowly moving to a full-time contract model. So that's a trend that we've been seeing.
Ramani, just to recap the numbers, how many partners are working either part-time or full-time, via the gig economy or for these platform companies? And what percentage, you said, would be doing it full-time, where the social security rules would be applicable?
About 10 to 15% looks like they're working for almost 8 to 10 hours full-time per day. And that's about 10-15% as of now. And during certain peak time, it goes to 20%. But majority, like 80% of these workers are working like a pure gig and working across multiple platforms, not exclusively for a single platform.
So what is the solution for that? As you said, most of them are working for multiple platforms. So the question is, who will bear the cost of the social security? Mr. Sarvanan, do you want to come in? I mean, what is the solution to this? If you want to provide safety, you want to provide social security, what's the best way to go about it?
Yeah, good morning. See, as Ramani explained very clearly, the gig workers are inclined towards this, and the potential ability for them to work on their flexible working hours. Is that something which they are all enjoying it? And with this latest intervention of the central government to have this wage code implemented, the social security part of it is going to play a major role in the overall numbers. If you already look at the numbers, it is not even breaking even at 600 rupees, at even at 50 rupees per rider payout. In these situations, if you are going to increase the social security, especially with the challenge what Ramani posted in terms of people working in multiple platforms, this is obviously going to increase the cost of overall this e-commerce. And at the end of the day, it is going to be the end users like us who are going to pay the cost. But on the flip side of it, people, employees, associates who are working in these e-commerce platforms are willing to continue because it gives them a lot of flexibility. But again, it depends on how much of it can be used for them for the longer run. But I can see a lot of people are slowly moving towards a permanent employment because of the social benefits, because of the long-term benefits which they are getting in. Because now that the payout is also very minimal, and people are slowly intending towards a permanent employment more than a gig workers. But obviously, the payout will make a big difference for the whole engagement.
It's a question which is not knowable at this point, but let me ask it anyway. Prashant here. Good morning. Ramani, do you think this issue will remain a sort of, it'll keep coming up as a political hot potato? I mean, it's not going to go anywhere, right? I mean, someone or the other will keep raising it because there are arguments to be made on both sides and strong ones.
I can't comment on the political angle to this, but definitely, since this is a sizable chunk of people who are involved, close to 1 crore cumulative all put together, and this has really been taken up even at the state government's level and local government level, and lack of even basic security like insurance, because the insurance that the platforms that are providing are purely for the job-related insurance, not any ESIC or any other medical insurance, just like how any other employee or a full-time contract employee would get. So that is the primary demand, and which is actually a genuine ask. And how this cost will be borne by these platforms is a question, but to be very honest, there is no other choice other than passing it on to the end users and end customers. And while some platforms have already started shifting some of these jobs and converting them to an employment model, it's not like they're making them or paying them anything higher. So typically an average rider, purely in a gig format, if that person is making about 21,000 per month, even after converting that person to a FTC, it's the same cost that the platforms are bearing, more or less. In fact, the take home is going below 21,000 because a percentage of that number has to go into PF contribution, ESIC contribution, gratuity, and others. So this is the main reason why even a large chunk of workers are still preferring the gig model rather than switching to a contract or a full-time employment model. So it's also a choice of the worker here, not just the platforms.
Just to that point about it being a political hot potato and this issue, constantly coming up, being a sort of a Damocles sword, the union claimed that more than 2 lakh people participated in the strike that took place on 31st of December. And yet on 1st of January, when these companies reported orders, it was at a record high. So it's even if some people do participate in the strike, the number of people who are willing to do this, either as a flexi or permanent, is just so much that I guess there is demand at every price point and every.
Shilpa was telling us that the union itself is not. I mean, it's very unorganized. It's split across so many platforms, across states, etc. So the union may call for something, but it's not as if. I mean, it's very difficult to tell how many will participate, not participate, adhere to it or not.
And it's not at a nationwide scale also. It was just, a few union workers. So, Ramani, is there any, other issue that you see to the gig model? And give us the growth projections also. I mean, what you've seen at TeamLease, because in the past, you've spoken about how this is the single biggest engine of growth for you now.
Yeah, this is one of the largest growth engines for us. In fact, over the last 2 years, it has been consistently giving us the highest number of open positions, even though we are catering only to the FTC model, not much on the gig model. And we believe that this model will continue to grow because now this is spreading across tier 2, tier 3 cities as well. So far, majority of the hiring that we are doing are largely in tier 1 cities and metros, but now even tier 2, tier 3 are catching up in terms of overall hiring.
Can you share some numbers for you at TeamLease? what percentage, what has been the growth last year? What are the open positions right now?
Yeah. So overall, out of the total headcount of team leads, currently we have about 6% of the total base with quick commerce and e-commerce related profile. And out of this, if I take only annual growth, out of that, close to 20 to 25% growth is coming from retail, quick commerce / e-commerce, this segment.
Okay. And is it possible to break up quick commerce and e-commerce? Because e-commerce has been there for a while. It's only quick commerce which has now come up in a big way.
Yeah. No, currently it's mainly quick commerce because e-commerce has been steady and the numbers could be about 10-20%, but majority is right now what we are seeing as new open positions, majority are with quick commerce companies. And in any given month, currently we are doing about 3,000 to 4,000 numbers purely for quick commerce related profiles.
Okay, Mr. Saravanan, Ramani, thank you very much for joining us on this discussion. We're out of time. Great to have you both share your insights. Get into a break. On the other side, we'll get the management of Senco Gold and Diamonds to talk about the Q3 business update and the outlook going ahead. Stay tuned for that discussion.
Welcome back. Gold continues to shine. And in that context, we have Senco Gold. That's actually buzzing in trade after reporting a strong set of numbers in its Q3 business update. The growth is led by higher gold prices as well as the festive season. To discuss this and what's the outlook for 2026, we're joined by Mr. Suvankar Sen, the MD and CEO of Senco Gold and Diamonds. Hi, Suvankar. First of all, wishing you, family, as well as the entire team a rocking 2026. It's been glittering in 2025 for you. Well, let's see how things pan out for this year. Give us a couple of details with regard to your quarterly update first up. What was the growth, the buyer growth that we saw, the volume terms, if you could help us out with that?
Yeah, thank you very much, and wishing all of you a very happy new year as well. In terms of what we saw, the Q3 results, the growth has been phenomenal. It has been a 51% growth Q3 versus the Q3 of the previous year. And if we look at the YTD numbers, we are growing at approximately 30% plus year on year. One of the major reasons why we have seen this kind of very strong growth is, if you look at and remember that Q2 was a muted Q2, the weather, overall people and the gold prices going up, consumers were procrastinating and delaying their buying decision. And what all got shifted into Q3 along with the wedding season and gold prices also moving up. All in all, I think that finally, with the increase in gold price, consumers thought that this was the best time to buy. And another thing that as a company we have done is that, keeping the higher gold prices in mind, our effort and endeavor was to create new designs and new collections that would fit into the budget of the consumer. Because if you see that while value-wise we have seen a growth, if you look at in terms of volume, like today, YTD, if we are up by 34-35%, but in terms of volume, we are down by 12%, which means that consumers are looking to buy higher and higher, budget in terms of maybe up by 20% budget, 25% budget. But in terms of volume, it has to go, the jewelry has to be made lighter. So this is how it has been. The good thing, another one, is that the diamond sales, we have seen that in diamonds and in silver.
Sorry, apologies. Let me just come in on gold. Let me just finish that loop on gold. Sorry, just the numbers. What is the tonnage growth? I mean, the volume growth in the third quarter?
The volume growth in the third quarter is it's -7 to 8%.
Okay, and value growth is
51%.
It's like on both ends of the spectrum, right?
Yes.
So it's largely pricing led.
It is.
Yeah.
Yes.
And this is only gold, right? We're talking about, or total.
This is only gold. If we
Only
look at
gold.
diamonds,
Yeah.
if we look at diamonds, we have seen that there is a 39% growth in diamond volume and value. So around 35% in volume and 39% in value. If you look at silver, silver also has seen a volume and a value growth. It is gold which is largely led by the value growth, and the volumes are under pressure by minus 7-8% because of this higher gold price.
So YTD, that is April to December, could you give us the same number? So for the 9-month period, value and volume on gold?
The 9-month period volume degrowth is around 12%. That's the kind of volume degrowth we have seen. And if you see the value growth, it is up by 31-32%. So that's the kind of 9-month figure that we're looking at.
If I'm not talking about whether gold prices come off, but say gold prices stay here. I mean, actually, generally, expectation is it'll do even better. So if it goes up or stays at this level, how long can this kind of this divergence continue, Suvankar, on gold specifically?
Well, I think that it will take some time for the consumers to get used to the gold price. What we see at the ground level, the reality is that consumers are buying jewelry. There is a lot of old gold exchange that is also happening. So around 40% of the business is led by old gold exchange that the consumers are doing. And with this increase in gold price, I can see that the consumers are trying their level best to match up and, be it for their own personal usage or weddings, trying to buy as much. But obviously, there are restrictions in terms of how much they can buy. And we have to make jewelry lighter. We have to look at 18-karat jewelry. We are also introducing 9-karat jewelry. So in terms of pieces, in terms of volume, you will see that, yes, with the lower caratage and lower lighter weight jewelry, volumes are going to take a hit. So that's the reality. And we just have to fit into the budget of the consumer. And that is what will lead to our success.
Okay. Two-part question. Suvankar, hi, Rima here. One, 9-month growth is 31-32% value. That's higher than the 18-20% that you were guiding for. So what happens to your FY26 top-line growth guidance? And how is Q4 likely to be in terms of the wedding season? Q4 vis-a-vis Q3, Q2. Give us a sense.
So, looking at the 31% growth that we see right now, I can, guide that our whole year's growth should be around 24 to 25% in a very conservative way. I've always been saying that till we have what we see, what happens in Q3, it is not right on our part to increase the guidance of 18 to 20%. But now that we have crossed Q3 and we are very much into Q4, and the wedding season is going to start from 15th of Jan once again, we'll have our Valentine's Day, Women's Day, and all the other various continuous weddings right up to March and April. I think that it is right to guide on a 24 to 25% growth for the whole year right now.
Okay, all right, Suvank.
As you questioned on looking ahead, what we see on the financial year and the calendar year of what's happening in 2026, as a team, as a company, we will continue to target and look at 18 to 20% growth for the upcoming year as well.
All right, Suvankar, a couple of more questions then. What is the studded ratio in Q3? And by the end of this year, what are the total number of stores you're looking to add?
So the studded ratio, we've been strategically looking at ensuring that how we can increase the studded ratio. It is around 12.5% right now. And what has happened and helped is that with the increase in gold price, especially for gift items, for lower ticket size items, be it earrings or pendants or rings, I think that for the consumer, it is fitting into their budget to buy diamond jewelry or platinum jewelry. And you must also take note that the way gold prices have gone up, the platinum prices have also been on a very strong upward trend. But all in all, I think we are at about 12.5%, and our efforts have always been to take it closer towards 13.5%, 14%, and towards 15%. And in terms of the store openings, we've opened around 4 stores in Q3. There are about 3 to 4 stores in the pipeline for Q4 as well. And we've always been focusing on opening 18 to 20 stores year on year. And I think that that's how we will always look at, and we'll achieve the similar numbers this year. And we'll aim about the same kind of numbers for the next year as well.
And studded ratio of 14 to 15% is in the coming fiscal? That's FY27?
Not 14 to 15%, no. in what is
Studded
we are seeing
ratio
in terms of the number of stores, 3 to 4 stores that we'll open, and about in the coming fiscal we'll again aim to open 18 to 20 stores as far as the new stores.
No, you also mentioned that the studded ratio is at around 12.5%, and that's likely to perk up, right? That goes to what level in FY27 is my question.
Okay. So the FY20 from a 12.5%, it will move to about 13.5%, and over the coming 3 years, we will take it towards 15%. I think that's the kind of a plan with which we are working.
So, Ankur, did we get the inventory gains?
No.
So you want to just close that with the inventory gains on gold in the quarter?
Yes. So our hedging ratio is around 50 to 60%. So we will be able to see some amount of inventory gains as well, because there is about close to 3 tons of inventory lying across all the various stores. So with around a 50 to 60% hedging ratio, I think we should be able to see some amount of gain from the inventory as well.
Okay.
How much? Can you give us a number in the ballpark?
Again, giving an exact number will be difficult, but from a guidance perspective, we've always been guiding that we will be doing an EBITDA of about 7% plus. So with what we see and with the results, with the performance of Q3, I think that about a 7.2 or a 7.3% EBITDA or upwards by a few bits will be possible. So it's a positive situation. Hoping that this momentum and this journey with a positive approach continues to happen in the coming quarters as well.
A quick comment before we let you go on Titan's entry into the lab-grown space.
Well, I think that's a very good sign. We've been believing in the fact that with the increase in gold price, consumers will look at various kinds of options that will fit into their budget for the occasions. And with Titan coming in, I think it's only going to make the whole industry more organized, especially the lab-grown diamond industry. And there will be more seriousness, more awareness. Consumer awareness will go up, and I think overall the market will be also becoming bigger and bigger as well.
Thank you very much for that, Mr. Sen. Look forward to chatting with you when your Q3 numbers are out. Well, for now, let's get back to the markets and address the market technical. Siddharth Rai Mangla, Senior Research Analyst at Stockbox Technologies, is here with us on the show. Siddharth, your thoughts on the first hour of trade and what would be the stock calls?
Hi, Rima. Good morning, and thank you for having me on the show. See, Rima, if we talk about Nifty, a very small range seems to be playing out very strongly on the index today, probably also yesterday. When we look at the options data, Rima, 26,100 on the downside, which is exactly where Nifty made its low today, is a very important support. And on the upside, 26,200 is a very important resistance for the index, which is what the options data is telling us. So this doesn't seem to be a very good time to be taking aggressive positions in the index itself right now, because somewhere Nifty seems to be in a waiting mode, probably because the heavyweight results are just about to begin. So it's not a good idea to be taking a fresh long or short positions on either direction in the index. It's much better to wait for the index to move out of this range, and it will be better to keep a stock specific approach as long as we are in this no trade zone in the index itself.
Okay, so let's get to the picks then, Sid.
Yeah, sure. Hi, Nigel. See, 2 stocks. The first one is Tata Technologies, which is one of the highest top gainers today. In fact, it is a very strong move. I think this is a sign of a very strong turnaround in this counter, which is why Tata Tech can be bought right now. Right now, the spot is trading around 680, 681. It can be bought here. The stop loss will be at 665, and our targets being the first target 710 and the second target 725. The second stock is Aurobindo Pharma. See, after a long time, the stock has probably given a breakout of 6-7 months, a big resistance of 6-7 months. So a fresh momentum is beginning in this counter also. So Aurobindo Pharma can also be bought. Right now, the spot is trading around 1257, 1258. We can buy it here. The stop loss will be at 1240, and our targets being the first target 1295 and the second target 1310.
Thanks very much for that, Siddharth. Appreciate it, and we'll speak again soon. Well, 26 points lower on the Nifty is what we have, 26,150. We'll take a quick commercial break here. We're going to come back. Commodities in focus. Manisha will be with us on the other side. Stay tuned. welcome back. 40 points lower on the Nifty, 26,140 is where we're at. Well, Cipla is the top loser on the Nifty. Ekta is here to tell us why. What's happening? Ekta, morning.
Morning. Well, Cipla is in focus because what has taken place is that their manufacturing partner, which is basically a company called Parmethane International and has a manufacturing facility in Greece, which manufactures the drug lanreotide, which is used for certain tumors, for Cipla, is under the scanner for the US FDA. So what took place is that in the month of November, the US FDA did look at their particular facility. This is Parmethane's facility in Greece, and issued 9 observations to that facility. So what has come to light is the 9 observations which were issued to that particular facility in Greece, which is Cipla's manufacturing partner for lanreotide. So now the street is fearing that those 9 observations are going to be difficult for them to solve, and there could be some kind of escalation. And if in case there is some kind of escalation, then that means that the lanreotide manufacturing could possibly be impacted going forward. Now, we still haven't heard from Cipla. This is a Novama note which is circulating at this point in time. We still haven't heard from the Cipla management in terms of, whether they've had a word with the manufacturing partner, what their response would possibly be to those 9 observations, because one would then realize what the costs would be going forward, and whether or not they do have any kind of alternate manufacturing plans for lanreotide. So that's the reason the stock is down around 1.8%, but it's recovered from the day's low.
1 3/4% lower on Cipla as things stand right now. Well, Manisha is now with us. We're shifting focus to what's happening in the commodity space. Gold, silver, copper, aluminum, you name it. Manisha, what are you focusing on?
Oh, they're all trading at multi-year and record highs as well. But I want to talk about silver right now because we've seen a new all-time high come in for this one. So this time around, 83.82 has been taken over on the higher side. And with that, in the last 1 week, we've seen 15% of gains come in. It's 40% up in the last 1 month. When you look at the gains overall, we are up 13% for this year. And this is after 148% of gains in the previous year as well. So, well, silver absolutely continues to shine bright there. I also want to tell you that between 2020 to 2024, silver kept trading between $20 to $30 an ounce. It was in 2025 that we saw that $30 an ounce of a range break, and then 40, 50, 60, 70 is what we saw. All of that coming in the year 2025 itself. I also want to talk about the gold-silver ratio. Last year, 2025, in the month of January, the ratio stood at around 104. We have seen the ratio come down to 59 right now, and it has been a great last 12 months that we've seen in case of silver. The last times when the silver prices actually rallied was in 1980 and 2011 when it hit all-time highs. And during those periods, the gold-silver ratio stood much lower at 14 and 32. So lower the gold-silver ratio, the higher the chances that you would be looking at silver prices going higher is what the study suggests. Why is silver holding even at these higher levels, even as we've seen so many gains continuing to the market? That is because there is a structural imbalance between supply and demand. We are looking at a deficit for a 6th straight year in 2026. There have been years of underinvestment rather, in case of mining, and is the reason the mining has not been able to react to the kind of gains that we've seen come in for the silver prices. Not just mining, when you look at the inventories, well, they are at a multi-decade low, supporting silver prices therein. It also has to do with very strong industrial demand. Almost 50 to 60% of all the silver available right now is going into industrial demand, supporting prices therein. And then there is strong investment buying as well, whether it is by the way of physical or ETFs. And then the refined availability also is becoming a concern. Remember, China has only allowed 44 companies, and that also is a restricted export starting from 1st of January, supporting silver prices yet again. I just want to take you through very interesting data right now, which is about industrial demand when it comes to silver. So whether it's about photovoltaic cells, high efficiency, power electronics, interconnects, all of that is where silver is used right now. So when you look at solar panels, 2 square meters of solar panel uses 20 grams of silver. And we do understand the kilometers and kilometers and miles of solar panels that are being constructed right now. And then the smartphones that all of us carry has 0.3 grams of silver into that. Is the reason the recycle, the scratching of silver from phones has been quite a narrative in the last 1 year. And then you also have TVs, desktops, laptops. They all have 1 to 2 grams of silver in each of them. And when you look at the battery EV, well, it has 25 to 50 grams of silver, and the number of this automotive continues to increase as well. Electronic industry overall, switches that is, motherboards, circuits, all of that uses 220 tons of silver per annum, which is only growing every year. So the markets are looking at much more higher gains from here on in case of silver. Interestingly, there was a Bank of America report which says the way the prices are and the way you're looking at demand and supply mismatch, prices can go to $135 an ounce. I mean, this is the highest till time that we've heard in sense of silver price forecast. BofA also says that $300 an ounce also is not ruled out, but their first case scenario is $135 an ounce. So, well, yes, much more bullishness from here.
Manisha, thanks very much for that. That's commodity price action for you, and it's largely everything up, except, of course, oil, which was down about 2% last night. We'll take a quick break. Lodha in conversation with Sakshi Gupta of HDFC Bank and Upasana Chachra of Morgan Stanley on the advanced estimates of GDP to be announced later today. Coming up.
Welcome to It's the Economy. The Ministry of Statistics, or MOSPI, will announce the first advance estimates of this year's GDP. A CNBC-TV18 poll expects the MOSPI to announce a 7.5% real GDP growth for the current year, and more importantly, only an 8.3% growth in nominal GDP. That is GDP unadjusted for price rise. This nominal GDP number will become the base for the February 1st budget. To get more on what to glean from the GDP numbers, today I have with me two top economists, Upasana Chachra, Chief India Economist at Morgan Stanley, and Sakshi Gupta, Vice President and Senior Economist at HDFC Bank. Ladies, thank you very much indeed for your time. Upasana, first, will nominal GDP the most important number to watch out for, and what are your expectations?
Hi, Lata. So for nominal GDP for fiscal 26, we are at 8.4%, so not very different from your poll. And on real GDP, we are a little bit higher at 7.6 for fiscal 26.
Okay. Would that be the most important thing to watch out for, nominal GDP?
Yes, I think in this environment of low inflation that we have seen, especially in the last 3 quarters, where the nominal growth has been moderating while real growth has been showing a robust trend, the nominal growth will be an important key takeaway that we will have. Also in context of, other derivatives that come through it in terms of fiscal deficit and implications for that with the upcoming budget as well, in terms of, how large is the base for the nominal growth that we can assume for the next year.
Okay. Sakshi, good morning and welcome to you as well. What would you watch out for in today's numbers?
Good morning, Lata. Happy New Year. Yeah, I mean, as you rightly said, look, these the numbers that we will have today. This is the advanced release. This is basically an extrapolation of the trends that we have seen in data up till November, right? So, in terms of drawing broader conclusions, especially at the sectoral level, for FY26, I think this number will essentially tell us what was happening in the economy up till November, right? And we know that a lot of the high frequency indicators till then, because of this, festive season demand, etc., were kind of holding up.
Yep.
Our estimates for real GDP growth is 7.4, but honestly, the risk to this forecast for me is clearly on the upside. So I won't be surprised if the number is much higher than this. As you rightly said, I mean, the most important relevance for these estimates is actually its implications for the fiscal calculation and the upcoming budget, estimates. On the nominal front, we are estimating, a number close to what your poll showed up, 8.3% growth in nominal numbers. I don't think that, if we get a number close to this, figure, that it really upsets the fiscal math for this year. I think what will be interesting to watch out for, and this will have implications for next year's estimates, what is the government going to assume, in terms of nominal growth for FY27, we are expecting 10.1, right? And that has implications for what they assume on tax collections, on debt to GDP, etc. So I think the most important figure in this release, as you rightly pointed out, is really the nominal growth assumptions that the budget will work with.
Okay. Well, Upasana, we've got some advance data over the past 4 months or 3 months. We just had a note from Elara, which is speaking about very strong auto growth in the September-December 4 months, that is post GST cuts, compared to the previous 4 months and the year ago 4 months. I mean, very strong auto sales data, and that's usually a very good lead indicator. So should we be prepared for even bigger upsides than 7.6? By the way, Upasana, at 7.6, you are among the highest.
You're very right, Lata. The high frequency data that we've got in the last couple of months, and especially I think, sectors which have got positively impacted with the GST tax cuts, has been very strong. So auto sales across passenger or two-wheeler sales have held up in the double digit, almost 20% plus sort of a growth rate if you were to average the last 3 to 4 months. That is very strong numbers. And I think if we were to further dissect it, like, festive to festive, which was very strong at 25% plus, but post-festive also these numbers are holding up, which is an important indicator to see whether this growth trend can actually continue to maintain its pace, or whether it sort of starts to fade out. So that is good news, because data up until December is holding up. And
Upasana, 1 minute. While I picked up the best fruit I could get, which was the auto sales number. But if you look at power consumption, that's been pathetic. Real estate sales, I saw some number of minus 17% for certain regions. Therefore, can Q3 be, still be a kind of dicey quarter to predict, and more so Q4? Are you reasonably convinced that the GST sales consumption, GST cut boosted sales will continue in Q4 as well? Are you getting that sense about consumption?
Right. So I think for Q3 or December quarter, I think over there is less of a risk of any, the numbers being lower than anticipated because of the GST impact. And you're right, power demand, there are certain pockets which have not done as well. But again, if you look at even power, that is now improving. So December is a plus 6% growth versus, yes, last few months, which were weak. Credit growth is picking up quite nicely. And so are, things like credit card spends as well. So there are certain broader indicators which are showing signs of strength. Q4 or March quarter, we would expect a deceleration, but that is linked to the base effect. And that would start to play out. So in our assumption, Q4 numbers would be lower than 7%. We are at about 6.8 on this base of GDP right now.
Okay. Anything else we should watch out for, Sakshi? Don't we often look for the private final consumption expenditure and the gross fixed capital formation numbers? Our poll threw up a number of 7.5% for consumption. You think that's a fair assumption, or would it be better?
Right. So a couple of points, Lata. So first, I mean, to your question on consumption and investment, I mean, look, we've had very strong numbers in H1, right? Both for investment and consumption. So, for the whole year, I think that given the recent momentum from high frequency indicators, I do anticipate that both for consumption and investment for the whole year, you should end up with a 7+ number. So for investment, for instance, we are projecting 7.5% for FY26. And for consumption, we are close to 7.2. But a lot of this is being driven by, on the investment side, because you had a lot of front loading of expenditure by the government in H1. So numbers were very strong. And then for consumption, I think the GST cuts, low inflation, etc., all these factors are playing out. Just one point I want to make to your earlier question, on the fact that some of the data, while yes, on the consumption side, things seem to be picking up and the momentum is holding on, but all the macro data that everything is not positive, right? And one of the things that I am closely watching or concerned about is the impact from government spending, right? So as we move into Q4, if the government has to kind of meet its FY26, fiscal targets, I do expect some amount of expenditure rationalization to happen. And I think some amount of that will actually fall in the fourth quarter. So, I would be a little, I'm not completely, overtly optimistic about Q4 numbers where, there's still some amount of uncertainty as to how much the growth momentum is going to be.
You want to add to that, Upasana? I think in your note, you also point out that we may have lower public expenditure because, for the second half, the base also becomes high. And there was a lot of front loading of both government capex and exports. So possible downside surprises?
So, I think as I mentioned, the Q4 number will see a moderation because of base effect. So we are building that part in. From a government spending perspective, this year is exactly like the opposite of last year, where the first up to November spending, especially capex, was so weak. And then there was a big sharp pickup in the last 4-5 months. And this year, as Sakshi has also pointed out, we are of the same view that it's not an easy year to meet fiscal deficit target as well, like we've been used to in the last few years because of tax buoyancy. So tax collections are running short of budgeted estimates. And in our view, the government will meet 4.4% of GDP, the fiscal deficit target. And therefore, to meet that, there will be a need to rationalize expenditure. So the impulse from public spending will be weaker, and especially, I think, in the last quarter. But some of it is getting built in these numbers, which are reflecting a moderation from December to March.
Okay, last 1 minute. So please, each of you take only half a minute for this question. Sakshi, how important is this very poor nominal GDP that we are seeing? Can we assume a better nominal GDP for next year? Or, will it be low nominal and therefore low tax collections?
So you're absolutely right. I think nominal GDP growth numbers very important. Below 9% nominal GDP growth doesn't bode well for a lot of indicators, including things like credit growth. I think for next year, what might work well for us that even with a real GDP growth between 6.5% to 7%, inflation will start picking up because there is a very low base. So we are expecting nominal GDP growth to be somewhere around 10.1.
Oh, okay, that's positive. Upasana, your nominal GDP expectation and worries?
So numbers similar to Sakshi, we do expect nominal GDP in fiscal 27 to revert to the 10% mark. Okay. I think, though, to your question, it's a very important indicator from a corporate revenue and corporate earnings perspective. We do think this low inflation environment will start turning. Probably December quarter should mark the trough from a nominal growth perspective, and the next 4 quarters should start showing a mild recovery.
Okay. Well, I did want to ask you all about how all these numbers will pale into insignificance on February 28 when we get a new series. Okay, very quickly, I believe we have time. Sakshi, you think all these numbers will look very, very different on Feb 28? Or will they look better?
Right. I mean, honestly, it's speculation at this stage. But yes, of course, as I initially said, I reserve my, drawing broader conclusions from this data right now because we are waiting because there's a series change, there are changes in methodology.
No, will it be better or worse? What's your sense?
Well, I hope it's going to be better, but this is
hope is not a data point.
Yes.
Upasana, expect it to be better when the new series comes?
I think if we go with the last phase revision, where we saw massive upward surprises in the new GDP series, just anchored on that, I think it could be better.
Okay. But you know what? It gave us a very poor FY14 number. It was a 5.3 or something. Yes. So it can cut both ways. Thank you very much, Upasana and Sakshi, for telling us what we should watch out for this evening when the numbers come. Well, that's it on this edition of It's the Economy. Time for a break. Chartbusters up next.